As I covered in the daily financial news for August 11th, next week is a monster week. It is important. We are going to get two of the three inflation readings for July. One of them will be on Tuesday, which is PPI, which is kind of important. And then we get the monster one on Wednesday. Will this be further validation that inflation is falling, or will inflation surprise folks and tick up, thus putting a September rate cut at least less likely? How can you cut rates when inflation is going up? We're going to talk with Mr. Dan Bird about all things inflation. How you doing, buddy?
I'm doing good. So what do you think?
I think inflation is going to surprise higher. I think inflation is going to come in
Really?
at 3.1. Yeah,
We're gonna have a very interesting discussion then,
absolutely.
because you know I'm the data guy.
Yeah, I know you are. I know you are. I'm the feelings guy. So there you go. Well, what do you got?
That's
What do
why
you
that's
think's coming?
that's why you should not be in the stock
And that's why I'm not in the stock market. Exactly.
market.
I'm a horrible stock investor. I've told you, and I've told the world that I'm not that guy. So works for me.
All right, well, let's start off by taking a look at the projections.
Mhm.
Um, I'll actually show my website just in case someone's joining this one. It didn't join the last one we did earlier. Breakpointtrading.net, and my newsletter is right here. It's free, put it out each week.
Yep.
So that's where you can get all the charts and stuff we're going to look at are there. In the newsletter, I put in economic calendar for last week and for next week. So this is next week's. So here's PPI, which is on Tuesday, projected. This is the forecast, projected to tick down. Core CPI showing 0.2, but it's actually for the year over year is projected to tick down as well. And here's
Okay.
the big one.
Yep.
2.9 is the forecast. And you think it's 3.1.
I do. I think it's going to go up.
I am going to say 2.8.
Oh, all right. Well, if we get let's just say it this way, if we get 2.9, or no, let's say it this way, 2.9, probably get a Fed rate cut. 2.8, 50 basis points got to be on the table.
Yeah, I think 50 will be on the table no matter what.
Okay.
But because remember, we have another unemployment report coming.
Another employment report. Yep. Yep.
Yeah. Okay, so 2.9 is the forecast. Remember that number. Now let me go to the charts page and let's first look at my CPI chart, which is right here in the left-hand column under economic charts. CPI
I really love
headline.
that you have all these here and categorized. That's pretty awesome.
Yeah, it's really helps me, frankly.
Hmm.
I mean, I used to create these charts and I would have to figure out how in stock charts to put them in folders somewhere, and then I have to remember
Yeah.
where the folders were. This just makes it so much easier.
Oh, see, I had this wrong. I thought we were dropping off. Okay, never mind. Okay, I got it. I'm right.
That one drops off in August.
Yeah, which
That's
is a
next.
small number,
It's
which is
small,
not.
but it's a little bigger than the month before.
Yeah, it's. I mean, yeah, it's not the next month. Like, see, what I always envision
Yeah,
looking at.
the next two are huge.
Yeah, and that's going to get inflation down. I fully expect the next two readings to be sub 3%. I just, I just feel
I
like
I
there's a
expect
surprise coming.
I expect the October reading
Mhm.
to be 2.5 or less.
Wow.
October. That's this one over here.
Yeah, I see it. Yeah. Well, okay. So let me
The
be we're clear. That's the October reading, which
for
will be for
September.
September data. Okay, got it.
Correct.
All
So
right.
this is the August reading for July.
Okay.
So it's a small one compared to these two, but it's bigger than the last two.
Okay.
And remember, the last one surprised to the downside.
It did.
Went from 3.3
What? Yeah.
to 3.
Okay.
This one's a little bigger than last one. The forecast is 2.9. Remember, the forecast was 3.1 last time,
Right.
and
Correct.
we went to 3.
Yep.
Forecast is 2.9. I think we get 2.8. Then we've
So
got two big.
I'll take the over. I'll take 3 or 3-1. Yep.
Okay. Then we got two big ones. So this one here in September will come before the next Fed meeting.
Correct. Yes,
So,
correct.
so if we get 2.8 here, we're going to get 2.6 here.
Okay.
Fed is definitely cutting.
No, if sure, yeah, you get inflation at 2.6, they're cutting and they're going to cut a half.
Yeah, here's what happened last time. Headline came in at 3, down from 3.3. Forecast was 3.1. But look at the 1 month rate of change.
Yeah, you actually had deflation. It was negative 0.1.
Deflation.
Yeah.
I mean, that will continue if we get even 2.9, that will continue.
Okay.
And then this is core down here. So you can just look at the trend.
Yeah, and what I saw for core,
yeah,
what I saw for core just this morning is expectation coming in at 3.2. So again, trending down.
Right.
Okay.
Yeah, and the core forecasts usually are pretty accurate. They usually come in pretty well. All right, so keep all of this in mind. So 2.9 is the forecast. I'm saying it could be 2.8.
Mm-hmm.
Now let's look at the second component that I always like to look at, and that is commodities.
Yep. Ooh, look at that. CRB, what is that?
CRB is all of these things over here.
Got it. Okay.
Agriculture, energy, industrial metals, precious metals. DBA is basically food components.
Okay. Mm-hmm.
And gas and oil are right here. So this highlighted area is what the next report will be based on.
I don't know about you, but I look at 4 of those 5 charts and I think recession. All of those are inputs. Copper,
no kidding.
gasoline.
Yeah,
it's
right.
They're inputs to stuff. Recession, recession.
Yeah, no kidding.
Okay.
All right. So the thing to look at here. So this is what the next CPI report. This is part of it. That's certainly not everything, but it's one of the key components, especially the gasoline and oil part.
For sure.
So you want to look at the left-hand side of this and the right-hand side of this. So food is basically flat. Copper, big drop in copper.
Huge. Yeah.
CRB, which are all these things over here, huge drop in CRB. Gas and oil, pretty significant drop there too.
Mm-hmm.
So put that together with the CPI chart that I just showed.
Yep.
And that's why I say 2.8.
Okay. All right. I love it. I love it when we make calls. I'll take 3. You'll take 2.8. The experts say 2.9. So we'll see.
Right. There was another one that I added. I put in agriculture. So this is, it just amazed me when I was just looking at the soybeans, corn, and sugar ones down here, how rapidly they have fallen.
Oh, yeah. Look at that.
The sugar was way up here. And here's soybeans right here. I mean, it's just falling off a cliff. And I actually would move this over here. It's for July. So they're going down as well. There's coffee, cocoa, kind of hung in there, soybeans, corn, and sugar. So these are all inputs for food. And they're just dropping off a cliff as well.
Yeah. And again, is that just a recession? Is that capacity coming online? Is it? It's just, it doesn't feel like the economy's holding together.
Right, exactly. Yes. And on that point, if we look at the recession watch components, so unemployment rate, I'm pretty much in the stance that we are already there for unemployment.
Okay.
You know, the SOM rule has been exceeded, but you know, there's articles that the SOM rule may not be valid anymore, and that could be true. But my thesis here,
Claudia SOM came out with that. Yep.
Yeah, but my thesis here has never been based on the SOM rule. It's been based on the unemployment rate spiking.
Yeah, rate of change.
That's right, and it is spiking. Down here is the rate of change.
Yeah.
You see right there. So these lines are basically where it started to spike before.
Mhm.
And then recession happened shortly afterwards. So that one, I put a check mark next to that one.
I agree.
Next one is Fed rate hikes right here. So every time
Rate cuts.
cuts, I'm sorry, cuts. Every time the Fed cuts, then recession follows.
Okay, so
Shortly
not
thereafter.
yet. No check yet.
Not yet, but it will be in September. So that check will come without question in September.
I like
So
it.
we'll have
So you're 100% certain.
100%.
All right.
Absolutely.
Are you 100% 50?
No, I'm not 100% 50 yet, but I think 50 is very, very low.
Okay.
And remember, we still have some more data coming. We got CPI next week.
We got PPI, CPI twice. We got
There'll be-
PCE once. We got a jobs number once. There's lots of
That's
data
right.
coming.
Yeah. And all of that data will just reinforce that the Fed will cut in September.
All right. So it's all going to be weak.
Yeah. So the third one is the inverted yield curve. Here's the 20-year view. So when it uninverts, we get a recession.
Right.
When it uninverts, we get a recession. It is not yet uninverted, but it's heading there. And in fact, I added in here a 3-year closer in view. So there's where we are right now. It actually ticked down a little bit last week.
Yeah, the close Friday. Yeah.
Right.
Okay.
So you can see the 2-year minus the 3-month down here. And this is the yield curve. So
let me ask you a question. So one of the things that I've said on my channel is when they finally backdate this recession, my guess was it's going to be June or July of 2024. I'm guessing you think that's a little too early.
Yeah.
Okay.
I don't think the recession is till next year.
Oh,
well,
even with all of this data, you don't think the recession?
Especially with all of this data. I mean, all the data that I'm showing you are precursors of the recession.
We just looked at raw material, aka commodities, falling off a cliff. That seems like a right now thing to me.
Well, yes, the inputs are right now, but that doesn't mean the recession is right now.
Okay.
But this one's going to be different, and we talked about this before. This is not an all-at-once recession like the last three were.
Rolling recession, absolutely.
This is a rolling recession, but I think it will actually be called a recession.
Oh, no
sometime
question.
In end of Q1, early Q2 of next year.
Okay.
That's what I think.
I think that's reasonable.
Right? So, and speaking of that, the last thing here that I'll leave you with. So this right here, I mean, you can look at the last two, and this is let me see what this is. Weekly. So this is a weekly chart. So each of these dots are 1 week, right? So we went from here to here in 1 week, from there to there in 1 week. If we had kept going up, we could almost have uninverted last week.
Right.
But we didn't. We went further down. So it probably will take at least 2, let's call it 3. Let's give it a month, maybe, to uninvert, which puts us right in September, right about the same time as the rate cut. And once there's a rate cut, this will absolutely uninvert.
Yeah, agreed.
Right. So 3 out of 3 sometime in September. All right. Now, what I'll leave you with is the chart that I forgot to put in my newsletter that anyone that's watching will be able to see. It. And somebody asked on the channel last week, you know, Dan has said if we get a recession, it will be short and shallow.
Right.
Why does he think that? So these are the last recessions that happened after the first rate cut. Okay. I got this sources Bloomberg down here, but I put in the secular bull and bear markets as I often do.
Yep.
Okay. So the reds are secular bear markets. The greens are secular bull markets. And what you'll see, first of all, you'll see in 2007, the bottom was on March 9th. So it's the first cut was September 18th, 2007. The bottom was 18 months later.
Wow.
Total decline 55%. 2001, first cut was January 3rd. The bottom was October 9th. Almost 18 months on that one. Down 42%. But look at 89, secular bull market. First cut was 89, July. The bottom was October of 1990, right?
Yep.
So that's a little more than a year, but only down 9%. Next three are secular bears. Again, down 22, 45, and 25. And in 1960 was a secular bull market. First cut was May of 60 and only lasted 52 days. And went down 7%. So if you look at these two right here, this is why I say it will be short and shallow, because we are in a secular bull market.
Yeah, I really get behind the shallow. It's really going to be interesting how they date this one, because a rolling recession could be actually pretty long.
Yeah, that's right.
Right.
I mean,
so
if they try
to
date it based on a rolling recession, which that's not what the NBER does.
True.
The NBER usually does it based on GDP. And you can't really capture unless they go right back, a year ago when the GDP first went down and then came back up again. They could say, well, that was it. But then they would have to end the recession shortly after that. Yeah. So you're right. It'll be interesting how they date it. But speaking of short and shallow, the COVID pandemic one, and I put an asterisk up here, recession was 24%.
Yeah, only 2 months.
That was not shallow.
No.
But it certainly was short.
Yeah.
So that was a short, but not shallow.
Yep.
So I think the next one will be short and shallow because we are in a secular bull market.
Well, I love it. We're going to be doing these calls every week. So we will both be held accountable. We will celebrate our successes and own our mistakes. So I love it. Any closing thoughts?
No, I think, I do have one closing thought. I think, and I said this in the newsletter, I think that we are going to get a big rally next week because depending on what happens in the Middle East, and if something happens, today or Monday over there,
right,
then we'll probably get a sell-off initially. But next week is options expiration week.
Oh, it is.
And
oh, wow.
As I've often said about options expiration, it's opposite George week for those Seinfeld fans. And that means that if the market has been going down, which it has, that means lots of people are buying puts because they think it's going to continue. In fact, as the market has bounced at the end of last week on low volume, they might be buying even more puts. And whenever the market's been going down, opposite week, options expiration means the market makers, it's to their advantage to allow the market to rally. Yep. So the market only needs to rally a little bit, but the market makers are not going to stop it. They're going to let the buyers just continue to come in and push the market higher so that all of that put premium expires worthless.
Got it.
All right. Let's add to that a 2.8 CPI number on Wednesday, right? And absolutely no doubt that there'll be a Fed cut in September. And you've got the makings of a violent rally towards the end of next week and maybe into the week after.
So let me ask you this. So let's say all that's true, but instead of 2.8, we get 3.0.
Well, if we get 3.0, then the CPI is not going to fuel the fires.
Okay. So there'll be no lighting of the candle, if you will.
Yeah, there won't be any fuel on the fire. Okay. I think the options expiration will still push it higher.
Right, but it won't be that like ignition, if you will.
Right. Okay. So I think in general, back to my comments about the which was in the last video, I think about the bear trap.
Yep.
That is going to cause a bear trap. Everybody's going to think that it's over, we're done, we're going higher. People will start piling in.
Getting out of their setup.
They're getting out of get out of their puts and their shorts, which will put more fuel on the fire.
Right.
That'll push it higher too, because to get out of a short, they have to buy.
Right.
So I think more people then will say, okay, that's it. The market's going higher. Everybody's going to pile in, and then we will have a big, huge downdraft before October.
Never boring. That's why Mr. Dan Bird comes back every Sunday and occasionally gives us a midweek update.
And I will add to that, that does not mean that will happen. The market can do anything it wants. I do not know what it's going to do. This is just my
guy's guess.
My opinion based on the data.
Yeah, one guy's guess looking at the charts. Dan, you're amazing. Thank you so much. Take care.
Hey, the next one.
Yep.
We're going to just look at some stocks. I had a couple of people ask me about some stocks. We'll look at those, and we'll look at the Magnificent Seven. It'll be a pretty quick video.
I like it. Let's do it.